Hey guys, it's Nick the Realtor from Keller Williams Cityside, and this is a Zoom discussion on the coronavirus and its impact on the real estate market. I hope you enjoy. So, so this is how the game is going to work. I'm getting ready to share my screen, and I'm going to show you a famous TV house. And let's see here. I'm going to show you a famous TV house. And in your chat screen, do you all know where your chat screen is? You see where you can chat.
Yeah.
So in your chat box, there you go. Somebody's written in the chat box. So in your chat box, you are going to write the name of the TV show, and you can write it to everyone because the person who answers it correctly first is going to be the one that gets the point. And the people who have the most points at the end of the game, there's about, I think we got about 10 houses. The people who have the most points at the end of the game are going to have a chance to win the opportunity to protect yourself from the coronavirus. All right, so first house. And this is the practice one. This is a practice one. So everybody write down the name of the show. What's the name of the show?
Oh, the name of the show, not the house? Okay.
So if this was real, Caden would have won. Caden would have won. The rest of them are not going to be this easy. This is the easiest one. All right. Here's the next one. All right. Cherie got that one correct for the first house, the Christmas Story. That is correct. All right. I'm getting ready to go to the next house. Uh-oh. Let's see here. Oh, Caden. Caden came in just before you did, Cherie.
Oh,
Just
no.
barely. Just barely.
Oh. Okay.
All right, here we go. Here's the next house. Nathan said this is hard to do on iPad. Davnit got it right. It is Seinfeld. All right. Here's the next house. was that
Oh yeah, I think, yeah.
Yep, you got it. Cherie, you got it first. All right, here's the next house. Candace got it. That's the friend's house. That's the friend's house. All right, what's this house? Yep, Cameron got it. All right. All right, which house is this? Oh, Cherie, you got that one. Let's see. I think this might be one of the toughest ones. So far, no. Oh wow, Davnit got it. Wow, that's Nightmare on Elm Street. All right, let's see. Which house is this one? Yep, Marissa got that one. It's Modern Family. What about this one? That's it, Cherie. Cherie, you're killing it. All right, this is the last one. Actually, hold on. Before we do the last one, let me count up what we got here. So we got Cherie, 1, Caden, 1. Let's see. Cherie 2, Devin 1. Candace, Cameron, Cherie 3. Wow. Davnit, I think 2. All right, so right now our leaders are Davnit and Cherie. All right, y'all ready for the last one?
Oh.
Hayden got it. Home Alone. All right, so it looks like Davnit, Cherie, Caden got. Anybody else get more than one answer? Yep, I think it was Davnit, Cherie, and Caden are our winners. And now, I'm going to share my screen with Kirsten to quickly give us some sponsor remarks. And our sponsor today is Multi-Nude. So Cherie, can you share your screen? Not Cherie, Kirsten, can you share your screen?
Okay, let's see if I can figure this out very quickly.
Let's see. I might be able to click on you. Yeah, no, I can't. I don't have the ability to share your screen. You see it at the bottom? You don't see a big button at the bottom that says share screen?
I do. I think I have to allow some privacy settings first.
If you want, do you want me to just go to your website and just pull it up from there?
Yes, please. That would be great.
Yes, I can just do that.
So while he's pulling it up, I'll just give you a little background about Multi-Nude. So Multi-Nude is a fashion accessories brand that was launched in 2018. And our first product, we were selling nipple pasties for women of different skin complexions. And so as of recently, we have converted our business to also make handmade 100% cotton face mask. So that's what we will be giving to you all for the winners of the game today. And so if you would like to check us out, our website is multinude.com, as you see on the screen. And we have a lot of different patterns for our face mask. As he's scrolling, you all can see. We update them as we get new fabric all the time, so keep your eye out for them. And then we also take donations. If you donate $5 for the first one you see on the left, I will make a face mask and donate it to medical professionals in the Atlanta area.
That is awesome. So that is multi-nude, where you can get your face mask to protect yourself against the coronavirus, and you can get multicolored nipple pasties as well. I don't need any of those at this current time. We might have some folks here in our audience who are looking for these. So thank you very much, Kirsten. I definitely appreciate that.
No problem. You all enjoy them, and congratulations to the winners.
Yes, yes. All right, so now we're going to get into talking a little bit about the real estate market and the coronavirus. I'm going to reshare my screen. Here, let me minimize this. All right, so here's and if anybody has any questions as we're going through this, definitely feel free to jump in. But the key questions that we're kind of be covering today are: one, when is the economy going to recover? Two, are we going into a recession? Three, is this going to be like 2008? Four, what about all the job losses? And five, what should I be doing right now? So that's the basic agenda of what we're going to be covering. And up front, I'm just going to say that I do not have a crystal ball and I cannot see into the future. So that being said, this would be this would cost a lot of money if I did have those abilities. So what the main focus of this is going to be is we're going to be looking a little bit at history, in addition to looking at what's actually happening in the market right now. And we're going to be looking at what the experts are saying, what this is going to look like moving forward based on those points of information. So the first question is, when is the economy going to recover? Historical analysis, and this is John Burns, and his company is specifically focused on real estate statistics, and this is all he does is nationwide. He looks at real estate numbers and what direction things are going. So, and he says that historical analysis has showed us that pandemics are usually V-shaped. So sharp recessions that recover quickly enough to provide little damage to home prices. And some very cutting edge search engine analysis by our information management team has showed the current slowdown is playing out similarly thus far. The Harvard Business Review has said it's worth looking back at history to place the potential impact path of COVID-19 empirically. In fact, V-shapes monopolize the empirical landscapes of prior shocks, including epidemics such as SARS, the 1968 H3N2, which is the Hong Kong flu, and the 1958 H2N2, the Asian flu, and the 1918 Spanish flu. So we keep talking about V-shapes. What is a V-shape? Goldman Sachs, JP Morgan, and Morgan Stanley anticipate the GDP to drop off very rapidly. And it's going to be quite aggressive for the first and second quarters of this year. They anticipate, though, by the end of the year, when things start moving back forward, there's going to be a sharp increase in the GDP. That's the anticipation of what this will look like. The next question is, are we going into a recession? And before we talk about a recession, I'm going to define what a recession is. They've actually adjusted the definition of what a recession is as of late. The National Bureau of Economic Research says that a recession is a significant decline in economic activity spreading across the economy lasting more than a few months, normally visible in real GDP, real income, employment, industrial production, and wholesale retail sales. recession does not always mean that there's a housing crisis. So with the exception of 2 recessions, this is Doug Bryan, CEO of Mind Property Management. He says, with the exception of 2 recessions, the Great Recession from '07 to '09 and the Gulf War recession from 1990 to 91, no other recessions have impacted the US housing market, according to Freddie Mac Home Price Index data from '75 to 2018. And these are the home price changes over the course of the last 5 recessions. And you can see in 91, it was 1.9%. And then of course, we all remember 2008, where there was close to a 20% drop in those housing prices. It's the question that everybody wants to know. It's like, is this going to be another 2008? And so many expect the housing market to follow that same trajectory now because of the coronavirus. What I want to talk to you about today are some of the distinct differences that indicate the housing market may follow a different path. So while the housing market was the cause in 2008 and 2009, this time it's actually looking like it could be one of the factors that bring us out of the recession. So if we look back at what was happening in the real estate market relative to the stock market from '07 to '09 dropped 51%. And annual home depreciation from 2007 to 2009, if you add those up, it's right around that 20% drop that we saw. So the way things are looking right now are very different than what it looked like in 2008. And what David Rosenberg, he's a chief economist at Gluskin Sheff and Associates, he's actually comparing this to more so what things look like after 9/11. And he's saying that the shock has generated fear, angst, and anxiety among the general public. People avoided crowds then, as they believed there was another terrorist attack that was coming, and are acting the same today to avoid getting sick. So the same parts of the economy that are under pressure, airlines, leisure, hospitality, restaurants, entertainment, those consumer discretionary services were hit hard in 9/11, and they're being hit hard right now. So during that time frame, 2000, 2001, 2002, the S&P corrected 45%. And home prices in 2000, 2001, 2002 actually increased at a very healthy clip. The other thing to take note as far as the differences, so 6 years leading up to that housing crash, literally over the past 6 years, the fastest growing year was 2017 at 6.4%. That was the slowest year back from 2000 to 2005. So the market was super overheated during that time period where we were having abnormal growth in real estate prices across the country. Right now, it's much more normalized. The other thing was, so they actually have something called the Mortgage Credit Availability Index. And it actually shows how easy is it for you to get a mortgage. There was a joke back in the early 2000s where they would say, like, if you wanted to get a loan, you would walk into the bank and they would take a mirror, and if you could fog up the mirror, you could get a loan. And that's what you're looking at basically with this 868.7 compared to the index today, which is 181.3. And actually, as of late, due to the coronavirus, the mortgage standards have actually been tightened up even more. The other thing that's very different is the housing inventory. So back in 2007, we were sitting at about 8 months of inventory. Today, we're sitting at 3. The definition of inventory is using today as an example, if no new houses came on the market in 3 months, everything would be gone. And I would say at its height, like back in like 2012-ish, I mean, we were sitting around 15 months of inventory. So today, we're really struggling with the amount of houses not meeting the demand. The other thing is how people were treating their houses. Back then, there were $824 billion of equity being pulled out of houses compared to $232 billion today. So if there was some sort of adjustment that happened back then, they were going underwater so fast, whereas today it's a different picture. Also today, of all homes in America, 50% of them have at least 50% equity. 37% of them own it free and clear, and 26.7% of them have at least 50% equity. So we're looking at a lot healthier homeowner at this point. And then also people aren't stretching themselves as much. Back in 2006, people were using a quarter of their income to purchase a home, versus today they're using about 14.8% of their income. Next piece is the job losses. So I've actually pulled up some more recent data, but as of March the 22nd, when I was putting this together, we were looking at 6.65 million job losses. The new numbers are going to be coming out on May the 8th, but when this report was done on April the 3rd, a vast majority of the jobs that were lost, 60%, were food services. So hopefully that 60% number are people that are being furloughed, and while they're being furloughed, they're filing for unemployment. Hopefully when things open back up again, that number is going to shrink dramatically. Goldman Sachs at this time is predicting unemployment rate to go 2020 to be at about 15%, by next year dropping to 6.8, and then by 2023 going down to 4% is what they're predicting. I just pulled this down today. You can see April 29th, 1:04 p.m. So right now, they're estimating that it's gonna be at about, right now, at about 15% nationwide. And right now, the new jobless claims are set to reach 30 million. And this chart that's here, this new one's gonna come out May the 8th. I'm very curious to see if I can get my hands on another one of these charts so that we can see what the diversification of industries that are being impacted in this way. Because this information is very helpful to see how many people are gonna be coming back into the job force. And this is kind of a comparison to show what we're looking at as we're looking at the unemployment rate relative to other calamities. So as you can see, during the worst portion of the Depression, back in the 30s, we were at about 24.9%. And during the Great Recession at its worst, we were at about 9.9% back in 2009. So what they're hoping is that with this one, back to that V-shaped chart, that this is going to be a quick recovery, and that 15% is quickly going to drop back down. The other thing to take note of is there isn't always a direct correlation to home sales and unemployment. So just because the unemployment rate spikes doesn't necessarily mean that home sales are going to stop. So that's something to consider, because not all of the people that are going to be impacted are going to be homeowners. So last question, what should I do right now? Well, number one, as Ben Bernanke said, in the absence of panic, the declines in the employment, consumption, and output in early stages of the Great Recession would have been significantly less severe. So at this point, absolutely do not panic. And as we watch how people respond and react, that's one of the key indicators as to us being able to move forward as people, continuing to not make rash decisions. The other thing that really take note of is at this point, like if you're sitting around waiting for this huge price drop to happen, this number that we're looking at down here at 2% of distressed property sales would have to go up quite considerably. And the way things are looking right now, do we anticipate that there will be some people who are going to need to sell their house as a result of what's going on with the economy? Absolutely. But what we hope will happen is there's enough demand and there are enough people in the marketplace in order to keep the prices from dropping dramatically. So compare that to 2012, when there was literally 35% of the properties were either foreclosures or short sales. And right now, they're really difficult to find, and very, very few of them that are occurring. So as it goes with real estate, I mean, it really is an important source of wealth. It's how a vast majority of people in America are able to obtain large sums of money, is by picking up real estate and using the home ownership in order to build their nest egg for themselves and for future generations. And thought this was a very interesting chart as well. It actually shows. Oh, and Nathan, did I answer your question there about the distressed properties being short sales and foreclosures? Those are what those are. I thought this was an interesting chart that kind of shows the appreciation rates across the different states. And then you can see Georgia there is sort of in the middle of the road at 4.4%. And that's a pretty safe number. Like if you're looking to purchase a house and you're trying to figure out, hey, look, what is my house going to be worth in 5 years or 10 years? What we're seeing right now in Georgia is about 4.4%, with some of your outliers being places like Nevada and California hitting that 10% mark. And then the last piece I was going to show you before I open it up to some questions that you all might have is I just want to show you a couple of Metro Atlanta specific data for April the 25th that was put together. So active listings. I really anticipated because of the coronavirus for there to be a significant drop off, and really new listings have been coming on quite normally. There hasn't been a huge disruption there. You can see the biggest difference was March the 22nd of last year. There was a huge spike in new listings, whereas it stayed pretty stagnant. But for the most part, week to week, the new listings that are coming on the market have been pretty consistent. The condo market, you're seeing the same thing. The last one I was looking at, this is detached single family houses. This is the condo market. So the condo market before coronavirus hit actually had more active listings coming on the market. And then after the virus started happening, you could see that the listings slowed down a bit, but they were still coming on at a pretty nice clip. Withdrawn listings are people who have put their house on the market and decided to pull it off. And I really thought that this number was going to be higher, and it's remained pretty consistent. with what was happening last year. And actually, yeah, and with the condo market, you can see there's a little bit more people who are withdrawing from the market compared to the single family homes. Now these are properties. Now this is where we're definitely seeing a difference. These are properties that are going under contract. So AUC means that the house is under contract, but it's still in a due diligence period, and pending just means that they passed the due diligence period. And this chart has combined both of them. And as you can see, and even before the coronavirus, last year's pending ratio, there were more houses that were going under contract. So we're still seeing houses going under contract at a healthy rate, but relative to last year, there is a decrease there. Now the condo market, there was a pretty significant decrease in the number of condos that are going under contract. I have some theories as to why, but I don't have a definitive answer. If I had to guess, I would say with social distancing, some of the buildings may have made it a little bit more difficult for people to get in and do those types of showings, because you've got to go inside, you've got to interact with the front desk, and you know, you've got to get on the elevator. So that may have caused some challenges. And also from the buyer perspective, someone's looking to go into the condo type situation, that may also have been a consideration. Those are just some theories. I don't have a definitive answer on that, but there is definitely a difference that we're seeing as far as the under contracts that are occurring. So that is, I'm gonna take the slideshow off. That's most of the data that's out there. And ultimately, I mean, if I were to sum everything up, is right now, literally I just had 2 closings that happened this week, and none of the buyers that I'm currently have gotten under contract have wanted to get out from being under contract, and the sellers that I have that want to sell are still wanting to sell. And I'm talking to other agents who are having the same experiences, where actually people at this time they actually have more time because they're home working. So I've noticed a lot of people are getting into the market, and the data seems to be showing that. Right now, I'll just go ahead and open it up for any questions. It can be related to this, what I just talked about, or it could be related to something totally just about the housing market, anything at all. Any questions?
Hey, what's up, Nick?
Hey, what's going on, Eric? How are you?
I'm good, man. Sorry, I joined the call a little bit late, so I missed the first half of it. But I saw some of your stats, and I wanted to know. I was curious, as you know, I'm in the mortgage business, and I wanted to know if, like, what you're seeing out there, you know, really after the coronavirus really hit the fan, you know, about 6 weeks ago. Have you seen any like trend of buyers having properties under contract, and then they may have lost their job and they can't get financing, or the lenders that they're using, you know, because as you know, the financial markets have taken a pretty big hit, you know, with the whole coronavirus thing, and it's had an impact on mortgages as well. So I was just curious if have you seen a spike in buyers getting a property under contract and having to back out for whatever reason post coronavirus?
Anecdotally, I've definitely seen that on a couple different levels. I've had some clients who qualified for X amount of house before the coronavirus, and then because they've tightened the standards, they don't qualify for much house right now, or they don't qualify at all right now until the standards change. And then on top of that, I do have some situations where a client was under contract and then either their pay dropped or they got furloughed. So that made it so that they couldn't purchase. So right now, I think those are some of the challenges we're seeing. When we saw those numbers of under contract, when we saw those dip offs, I think that's what that is right now, there's a bit of uncertainty. So I think people are kind of holding back a little bit. But I think there's a sentiment right now that once things stabilize, that there's a lot of demand of people who are wanting to move, but are having some challenges. Not everybody's having challenges right now, because there's a lot of people who are still able to move forward, but we are definitely seeing that there's a segment of the population that wants to move, but for some reason can't because of what's going on with their job or because of the credit standards.
Perfect. Yeah, that answers my question.
Awesome.
Thank you.
Thank you, Eric. Anything else out there? Any other questions?
Yeah, I have one. So for people like myself who have a lot of, went to professional school and we have a lot of student loan debt, and just because, and because of the coronavirus, but in general, a lot of us are making those big student loan payments, although they're temporarily on pause for some. What would you say to those people who would like to buy, but don't necessarily have like a lot of money to put towards a down payment and don't necessarily have a great debt to income ratio at present?
Yeah, so there's two things. The first part about the student loans is depending on the type of loan that you get, they calculate the student loans differently. So sometimes they'll look at the total amount, and sometimes they'll look at what your monthly payment is and not really look at the total amount, depending on the type of loan that you're getting. So that's one thing that we can kind of play with. And then as it relates to down payment and closing costs, there are, depending on your situation, ways to work around that. I'm currently working with a few lenders who have 100% loan programs. And then there's also out there down payment assistant programs that can help cover your down payment and your closing costs that are also available. They're not perfect for everybody, just depending on your situation. But I've literally had clients who were in a situation where they closed on their loan and then they left the closing table with a check because there was too much money and they couldn't apply it all. And then they left the closing table with a few $100s. So they didn't even have to come to the table with any money. So there's different ways to tweak it, but there's no one size fits all. It all depends on, because the lenders are going to look at your income levels and they're going to look at your credit scores, and the mixture of all those things will determine the type of program that you would have access to.
Right. Okay. Yeah. Because at least myself, when you talk to your parents and your other relatives who bought and sold properties, they're like, oh yeah, you have to have like X number of dollars to put on a down payment, and then you're just, you just end up renting for probably way too long.
Yeah, no, that's a great question. I think there's a misconception that you need to have $40,000 or $50,000 saved up before you can move forward in purchasing a house, and that's just not the case. You can have that, and it can be very helpful as far as getting your payment down, but it's definitely not a requirement.
Okay, gotcha.
Any other questions out there?
Hey, Nick.
Hey, what's going on, Terrence? How are you?
I'm good, man. Do you have any statistics on commercial properties, how they're being affected right now?
I do not. So I primarily focus on the residential side. I don't have any stats on the commercial. So I've got partners that I work with on that side, but it's going to be interesting because you've got multiple elements of commercial, right? You've got the massive multifamily apartment buildings, and then you've got the commercial where people are going in and they have like office parks, big office parks. And then you've got retail. And all of those are going to be impacted in completely different ways. And I'm sure a lot of them are trying to figure out what that's going to look like, because if you are in a complex that's retail that has a couple of restaurants and you've got some gyms, like how many of those guys are going to be able to make it, make it through this time period? And then as far as like these office buildings, I don't know. I wonder if one of the theories that I'm seeing is there's so many people working remotely now. So I wonder if after this happens, if there's going to be a certain percentage of people who end up continuing to work remotely, and then if the demand for office space might shift. I don't know. I don't know what that's going to look like. But at this time, I haven't looked at any specific commercial data, but I've just kind of just been just watching to kind of see what's going to happen on a more macro scale, but I haven't looked at anything specific there. But there's just some thoughts that I've had about it. Okay. I don't know if anybody else here has any experience on the commercial side that they could give any input on.
I can share some insight on the from the financial standpoint. I don't know about all of, because there's a ton of lenders out there, but the very small circle of lenders that I'm aware of, the majority of those lenders have suspended commercial funding. So that's definitely going to have an impact on commercial buyers that are looking to buy commercial property that need to get a commercial loan. Most of those lenders that are offering commercial loans got everything on hold. I mean, it's a freeze on a lot of those type of loans. So that's definitely going to impact the buyers out there if they can't get a loan.
Okay. Thank you for that input, Eric. Is there any other questions? Awesome. Well, I think
someone in the chat wrote, could you define distressed property sales?
Oh, they did. That was a while ago.
Oh, okay. All right.
Yeah, and I think we got that. I think we got that answered when we were just kind of talking about the fact that it was foreclosure. And just real quick, just to talk on that piece really quick as it relates to the foreclosure market. There are 3 times that you can buy a foreclosure property. The first step is right in the beginning stages when it gets put in the paper because someone has missed a couple of payments. And during that phase, it's usually very difficult to get into contact with someone unless they want to sell their house. Usually how people do this is with like a shotgun approach, is they'll get the big long list of all the people who are missing payments and then send letters out to them. But you're not the only person to do that. There's a bunch of investors who are out there sending letters to these people every month, trying to see who might bite. What you hope happens, which will help the market, is if people get into trouble, they'll reach out to somebody and either sell their house or put it on the market before it's too late. If they wait too long and they're right there and they got to go to the courthouse steps and the house gets sold there, it has to be bought cash. You don't have the ability to pull out a loan and do a typical title search and all that type of stuff. You got to do all that stuff up front. You got to have cash in the bank, and it's a process that you want to have a very strong system for doing so, because you can get burned if you do it incorrectly. And then the last step is if it goes to the courthouse steps and no one buys it, it'll go back to the bank, and then the bank will usually end up, at this time, like they used to just sell them and they would be all you know, they wouldn't fix them up or anything. As of late, though, more of the banks have just been fixing up the properties and selling them for market value. So just because you're buying something from a bank doesn't necessarily mean you're going to get a great deal. But there will be some opportunities. There will be some folks who get into a tight situation and have to sell their house quickly. And I anticipate us seeing more of those than we saw in the past just because of what's happening economically. Any other thoughts or questions on anything?
Nick, do you have any thoughts on where the next hot area of Atlanta might be? You know, if someone were to looking to buy an investment property, where someone might, you know, going to be looking in the future?
Yeah, so one of the things that a lot of people have been talking about and we're seeing a lot of growth is right around the Atlanta Beltline. And if you're not familiar with that, that's a good thing to Google and look up. And there's specifically these connections of trails, and there's going to be a lot of economic development that goes into those trails. And they're going to be putting different mixed-use developments there, and there's going to be apartments there. And in those areas, if you're able to pick up a property, you might be able to pick up something before significant development goes there. And then there's another area, if you want to Google this, called the Bellwood Quarry. And there's going to be a lot of investment there. There's some people here on the call who know quite a bit about that. But they're actually going to be putting a park there, much like Piedmont Park. But they're saying this is going to absolutely dwarf what Piedmont Park looks like as it relates to like the open green space and the type of development that's going to go there. So there are definitely a lot of areas in Atlanta. And then, I mean, truth be told, there's so many great opportunities just around, in the sense that if you look at the numbers, Atlanta's ranked like top in the country for people moving here. So there's just going to be a demand for housing here in Atlanta just because of the sheer fact of supply and demand, and there's people coming here. And so yeah, so there's a lot of different areas, but those are a couple that, you know, that come to mind that there's been a lot of buzz around that.
Okay, thank you.
Hey, Nick, I have a question. It's Nathan.
Hey, Nate.
So as it relates to on this point of investing into property, like I said, of course, in Atlanta, there's a lot of upcoming properties and things of that nature. But even if you're interested in investing in other areas, even outside of Atlanta, what type of loans, or could you further expound upon loans that could assist with renovating properties, you know, as well as, you know, of course, purchasing, but more so for renovating, you know, a nice little property that you're wanting to quote unquote flip or something of that nature?
Right. No, that's a great question. So as it relates to fixing a property, there are some programs if you're going to live in the property. So owner occupied situation, there's more flexibility in the lending. There's a conventional product and there's an FHA product. One of them is called Home Styles and the other one is called 203K. And these are renovation loans that, let's say there's a house that you find for $200,000. And then there's other houses in the neighborhood that are worth $300,000. Then you can pick up this property for $200,000 for 3% down. And then you could put, say, $60,000 into the property, putting in the new bathrooms, putting in a new kitchen, putting in all new floors. You got to go in and fix the roof. You can put money towards all of those things. And then after it's all said and done, there's something called ARV, your after repaired value. And after you put your money into the property, the situation you want to be in is that house is not worth the 275 or whatever that your total mortgage is going to be, but now it's going to be worth 325 or 350. Full disclosure on that, it is not for the faint at heart. It's a lot of work going through those, and you got to have your general contractor. You got to stay on top of your contractors. You got to make sure they're doing what you want them to do. Oftentimes, the original plan isn't the plan that you get at the end. So it's definitely a process, but those loan programs are out there. And if you're looking at doing it strictly as investment, the banks are usually requiring about 10 to 20% down payment in order to do a type of investment type program if you're not going to live there. And then the other option, if you want to do more of a flip type situation, there are things called hard money lending. And there are lenders that are out there that are doing kind of short-term financing, and they'll do it the kind of the same way as a 203K loan. And if you're able to get enough equity in the property, they're expensive. They're going to charge you, pretty high interest rates on top of some points on your mortgage. But if you can make the numbers work, a hard money is another option for picking up a property and doing a flip. But there's programs out there to do that.
Awesome, thanks.
Absolutely. Any other thoughts, folks? Awesome. Well, it's about 8:54. I didn't want to take up you all's whole evening. We're getting close to 9 o'clock. I hope you all enjoyed yourselves. I hope you had a little bit of fun with the trivia. And make sure, I believe, does everybody have my cell phone number? I'm going to put my cell phone number in the chat. And if I have your number, you know that I have your number, but if I don't have your number, please text me your information, especially if you want a prize and I don't have your contact information, so I can make sure that we get you your mask and all of that. So, well, thank you all very much. I definitely appreciate you coming to hang out.
Thank you. Very informative.
Yeah, before we leave, we definitely want to say thank you for this. It was definitely very informative. Could you possibly tell us when the next information session will be so that we can plan accordingly?
That's a great question. I don't have it planned, but what I will do is on my website, if you can check back there periodically at NIC.com, I do have an events page, and I'll put those events on there, and I'll keep you guys posted on those types of things. And then also, if I have your email address and your phone number, I'll keep you abreast of any new type of events and things that are coming up. But thank you so much for that, Nathan. I appreciate the question.
Awesome, thank you.
All right. Well, thank you guys. All right, well, y'all have a great evening.
You too.
Thanks
a lot.
Thank you.
Have a good night, man.
Thanks, Nick.
Thank you.